Welcome to ECR Tools. This video basically is part 2 of the first video that was made concerning rising interest rates in the UK and how this is adversely affecting families in the UK with mortgages. If you're new to this channel, remember to subscribe to our content, like and share our videos, add your comments and contributions. We are interested in hearing from you, from your opinion, all as part of learning and finding solutions to the problems that we face today. Now, following on from for the part 1 of the video, I did mention that I'll bring in the figures, i.e. concerning inflation figures, interest rate figures, average house prices, average income, and obviously some profits of some companies. So that you can see this information for yourself, listen to the analysis, and make up your mind, where this whole thing is going. Now, as I mentioned earlier, the consumer expert, Martin Lewis, did mention, basically giving his opinion about the fact that it was not recommended for the Governor of Bank of England to increase interest rates any further, due to the damaging effects this could cause normal households within the UK. But it seems the governor went ahead, that is the Governor of Bank of England, Mr. Andrew Bailey, went ahead to increase interest rates to 5%. And so now your typical 2 or 5 year UK mortgage is in excess of 6%, which can potentially mean an increment of about £400 extra per month, which then works out to be nearly £5,000 a year for homeowners that live outside London, and probably something like £800 to £1,000 a month extra, amounting to almost £12,000 a year extra for homeowners within London. So this situation is dangerous. It's rather dangerous, and it's just unbelievable. Now, it seems to me that UK is probably the only country in the Western economy that seems to have some probably talks not so negative about families losing their homes. People see it as an opportunity to come into the UK market to buy homes from normal hard-working UK families that are just working hard to keep a roof over their heads. Now, when these comments are made, about this rising interest rates leading on to rising mortgage rates, what we get from the Prime Minister Rishi Sunak and also from the Chancellor Jeremy Hunt is that this is a normal problem that occurs, that is going on in the entire world, or in the entire Western world. The real facts are that that is not true, because typically, if you look at a mortgage in Germany, they basically have the term of the mortgages expressed in 10 years, 15 years, 20 years, and 25 years. And their typical mortgage is between 2.36% to 2.6%. And so when you take up this mortgage, you are fixed for either the minimum is 10 years or 25 years. And so when there is an increase in interest rates in between, it does not actually impact how much the mortgage holders are repaying per month. And therefore, this only impacts, other minor items in the household expenditure, such that it does not destabilize the family, or families don't lose their homes if interest rates does go up. Germany as well, one thing that they also have is that if you're taking up a mortgage, they will do obviously your affordability, and it will be based on you not exceeding 40% of your disposable income. Now, if you take America, for example, as mentioned in the last video, once again, their mortgages are for 30 years. And so as far back as last year, they have 30-year rates that were fixed at 0.95%, basically less than 1%, 0.95%. And so currently, the US rates are probably something around about 7%, but this means that you have the choice not to take up that 30-year rate, as at this moment is high, so you can actually wait for it to drop. US inflation rate is around about 3% at this moment. And so the UK is in this situation where they have mortgages with term, obviously with fixed mortgages that goes up to 2 or 5 years. And so with interest rates going up to 5% and obviously leading on to mortgage rates that are in excess of 6%, this is extremely damaging for families with properties in or outside London. Now, you do get that argument where people talk about the sort of early 1990s, late 80s to early 90s, where rates were 15%. The argument is, at that time, the ratio of your property to your income, your salary, was about 3, was a ratio of about 3, 1 to 3, or maybe 1 to 3.95. And so you could afford it. And in those days, when you got those sort of rate rises, you did used to get a sort of an indexed related, inflation index related pay rise. And so you were then covered. But now, typically, you're seeing homes outside outside London saying having ratios of about maybe 1 to 6, and within London as much as 1 to 10 or 1 to 12. And therefore, when you have a slight increment in the interest rate, the effect is so damaging. And the UK, as I said earlier, seems to be the only country in the Western world where when markets are about to crash and people are about to lose their homes, hard working families losing their homes, we don't seem to attach the seriousness that it deserves, but people see it as an opportunity to go into the market to buy, basically forcing families to lose their hard-earned assets and getting it to the market so that people that have access to money can come in and buy. This type of thing is no good. Now, today we got further announcement from the Governor of Bank of England and Mr. Andy Bailey, and his recommendation once again is that by 2026, the average UK mortgage holder will be paying an extra £500 a month, which works out to be about £6,000 a year by 2026. So you see a governor that seems to be, if I make an analogy as a bus driver, that seems to be driving his passengers into a wall and doesn't seem to really care or willing to listen to anybody, but on that mission of going for a crash regardless. This, I don't know if this is a very responsible way, or a way that gives any kind of regards to hardworking families in the UK. Now, I'm going to go straight on to basically bring out the figures that I've collated. Once again, as I always say, you can choose to agree or disagree with me. That is not a problem, but I'm just basically bringing out that information, and I'm also willing to listen to, your contributions. Whatever you think, I'm willing to listen to it to see how we can find solutions to this problem. Now, as far as I'm concerned, the main cause of this inflation is the 450 billion pounds, or basically the cash that was printed by the then Chancellor, Mr. Rishi Sunak, between the last quarter of 2020 leading on to the end of 2021. It's 450 billion pounds of printing cash. Now that really wipes out any money, the value of any money that anybody was saving in a bank, and obviously has been one of the major causes of the inflation that we are facing today. Now, the other cause that I once again raised in the previous video was the lack of regulation. And so you're finding, your fuel stations, your supermarkets, your corner shops, your airport parking charges. Basically, everybody is just putting up their prices willy-nilly because nobody goes in there to regulate them, to ask them to account or give a justification of why those prices are just going up and up and up. I actually personally experienced a situation where overnight I saw a 50% increment, in a local shop, of prices, and this was on each single item. And so this becomes a real problem that really needs to be addressed. Now, without further ado, I'm going to go into this video and play it. This video is about, it's on the Great Debate, and it was a comment made by Lord Moyland, who is a Tory peer. And so you may want to be quiet to listen to what he has to say, and then I can then go on to show the figures that I've collected with inflation and the lot.
Lives, because many are so stressed due to the immense financial pressure that they're under, and I hear this all the time. So for me, it's either a snap general election or why don't we bring back Rishi Sunak? He knows what he's doing.
Wow. Okay, stick with us for a moment. Dana Moyland, there's a straightforward recommendation.
I'm not going to pick up on that, I want to pick up on
Well, no, why not? Why not? Just
I think Rishi Sunak lacks credibility as a national leader, I'm afraid.
But wasn't what he said about what would happen in the wake of Truss's economic plan more or less exactly?
Yeah, but being right
true?
once doesn't make up for...
That's right on a whole package of
being
things.
right on one thing, well, one package of things. One thing isn't
if there's a direct comparison between the two administrations, he's certainly in recent times.
Yeah, well, you talked about democracy. We've all talked about democracy today, and this means whereby people who lose elections get to win. So, I mean, where does democracy count in any of this? I personally wouldn't regard Rishi as an appropriate successor to this Truss if she was stand down. I want to make a very quick point about Julia. I think she's right. She talked about quantitative easing. What she actually meant was what I call printing money. We've been doing that for many years now, back to 2009, and it took off massively as a result of COVID. Not borrowed money, printed money, just printed on printing presses.
And by that,
that was bound to lead to inflation. And looking at this issue from the debt side of it is to look at the wrong end of the telescope. We have a huge inflation problem in this country, which will only be dealt with by higher interest rates. The Fed in America has led on this.
But that is about half.
And so there you have it. Lord Moyland, who is a Tory peer, has clearly mentioned that danger of printing cash, 450 billion by the then Chancellor Rishi Sunak. When you do that in an economy, all that you're going to get is inflation, because when you print cash, by the next year, obviously the impact would have been felt from 2022, the later parts of 2022 onwards. So this is what we are experiencing now. This is what is causing that problem. And so when, as the government, you print that money, knowing the effect of how that will impact families, when you take that action, then that action is not very responsible, because when it comes to the money supply, there are ways, especially in this modern day, where most people are actually economies are surviving basically on basically credits, paper credits. There is not, the need is not there to physically print cash. You must always keep your money supply at a certain amount. And especially if we were actually within Europe, there is no way that the then Chancellor, Rishi Sunak, would have gotten that opportunity to actually print that amount of money, because there would have been certain criteria to meet, i.e. in terms of money supply standards or settings that you, as a member of the European Union, you would have had to comply with. But let's quickly go through the figures here. So as you can see, I've compiled data of inflation from 1985 to 2003. So you can see it in a line graph right in front of you there. Now, if we start off with 85, inflation rate was about 6.1%. Then that sort of went further down, but then picked itself up and peaking at about 9.5 in 1990. And thereafter, there was a downward trend all the way down, falling to sort of 1.5% in 1999. And then it remained very, very low. And once again, sort of the 3-4%-ish. Even as far as 2009, it was actually less than 0.5%. And so, it carries on to your sort of 4.55. Then it sort of comes up a bit in 2011 at 5.2%. And then once again, it goes all the way down to 1% in 2015. And then you see 2022. So you can see here, as at 2020, when we had the COVID, even at the point where we had supply shortages, there were things like rationing. So we were using things like rationing. So whereby when you go and there was a shortage of, say, toilet roll, you wouldn't then increase toilet roll from maybe £2 to £4, but rather you keep the price at the same level and then you ration it. So you can see that actually happening in 2020, where inflation remained at 1.5%. And then by 2021, when we started to print that large amount of sterling done by Rishi Sunak, the then Chancellor, then you start to see that by 2022, that now filters into the economy. And then obviously with other factors like the Ukraine war and the cost of living crisis and all these things, and the Kwasi Kwarteng and Truss, this artificial shock, then you see that really bumps up inflation to 11.6%, which is the highest ever recorded since 1985. And then this is now basically slowing down and currently sitting at 8.7%. Right. So you can see the graph there. Everything is very clear. This, in view of what has happened, hardworking UK families are not the ones that are supposed to be paying for this, one will say, not so responsible act at that time. It's not the normal families that are supposed to be paying for it. So really, what should be happening is that 2% inflation target, which is being used as the yardstick to increase interest rates, should be adjusted because it's unrealistic. Now, if you do look at this data, one thing that is also evident is that it has not always been the case that, inflation, when it's high, then you increase interest rates, because you're going to see when we move on to the next set of data, which is the UK inflation data. But then what must be mentioned here is that in the times of Tony Blair's government, which was about 97, the then Chancellor, Mr. Gordon Brown, separated the control of interest rates. It was basically the Bank of England got that sort of independence to control that aspect of the economy. The interest rate control was shifted to the Bank of England. And so the idea was that to basically avoid that boom and bust that we used to have, whereby politicians used to use interest rates to control the economy, so that when we were nearer an election, they will always lower the rate, then the economy feels good, and then people vote for them, and then soon afterwards they increase it. So Gordon Brown brought that idea of basically giving that power to the Bank of England, and it was given to them to act responsibly and to the best interests of the British people. At this very stage, I don't know, and I couldn't say that the governor of Bank of England, Mr. Andrew Bailey, is acting in the best interests of the British people. I cannot see it like that, because destabilizing homes have such damaging consequences for families. Mental health issues, homelessness, basically destroying it. It actually destroys the family. Every European or every Western economy seek to look after families and look after the people of the nation. And so we are seeing that this type of thing is not happening here. And it is a real concern when you compare this economy to the Scandinavian economies, Denmark, Sweden, Finland, Germany, when you go into Europe, and even America, where, it is known that basically, it's a free-for-all. Everybody, goes out there to do their own thing. Even there, you have fixed mortgages that last 30 years. And so this type of situation that we are in should be really reconsidered. Now, if we go to the next set of data, we now come to the interest rate data. And so this is where I was saying that if you look at the previous data, you probably noticed that around about, say, maybe 2009 thereabout, and I'm probably going to go back just to be more precise in the argument that I'm making here. So if we go back to, say, let's say even 2007, where we see inflation at, say, 4.3%, and we're seeing in 2010 4.6, 2011 even 5.2. When you come and look at the interest rate data, when you come to, say, 2011 and the lot, you can see that the interest rate was very low. You can see they will all be, it was like 0.5%, but then inflation was about 5% or 4%. And so if the interest rate could be kept this low, even at that time when the inflation was considered to be 4%, why is it that now you want to use, you want to basically say you're using a 2% inflation rate target as the yardstick to bump up interest rates? And so, if you think about it, this argument does not necessarily hold. You really need to take care of families. You need to consider using factors like the average house price. In London, it's £550,000. Average incomes in London is about £42,000. And so the ratio is about 1 to 13, 1 to 12, 1 to 13. And so if interest rate goes up by just 1%, the impact is so damaging. Now, if we look at the interest rate data here, we can see, in 1985, you have something like 11.38%, probably highest 14.88%, which is about almost 15%. So this was the time that a lot of families did lose their homes, but it wasn't as bad as it is. Well, it's going to become in this era, because in those days, as I said, your income would have had that indexation, so your pay would have risen in line with inflation, such that you get some sort of protection. Then also, in those times, even if the interest rate went up to almost like 15%, savers, this 15% was passed on to savers, so that if you were a saver, then you could actually receive a higher interest for your savings with the banks. But it is known, or we know from obviously from news report, that banks are charging this rate, but then they are not willing to pass on the rates to the savers. And so, they were called in, and this is a fact. And so even if the rates are going up to 5% and mortgages are going up to 6.99 or 6.5%, then people that are saving money should actually see their savings rate go up in line with this rising interest rates. And so once again, you look at the interest rates, then it starts to fall all the way from sort of 92. It comes into reasonable figures, which is, sort of your average of 6.5%. Then once you start to hit the 2000s, it drops further. 2001 at 4%, 4%. And then, it sort of hovers around an average of about 4% till 2009. So from 2009 onwards, as you can see from the line graph, that the interest rate is basically fallen flat, below 1%, 0.5% was retained for a very long time. And obviously the correlation between low interest rate and high when basically house prices is that when the interest rates are very low, then you are going to see your house prices basically double. So in that period, we will go into the average house prices data. You are going to see if you take from say 2009 to about the end of say 2021, 2022, you may then find that house prices did double, and this is what create that massive gap between your income and the ratio, a massive gap in the ratio between your income and the house price, and making it so unaffordable to the average person. And this is the reason why rates must be kept low, or the UK can adopt that situation just like the German system, whereby now interest rates for basically mortgage rates are set for 10 years, for 15 years, and for 20 years. And if that is done, then once again, there wouldn't be any problems. So I'll go on next to the data on average house prices. So obviously we can see here, let me just cover this properly. So this remains so low up until 2020, where we have a 0.1%. So that was like free money. And this, come up to say 2022, we are back to 0.5% again, which is extremely low as well. And then now we're seeing the rise of up to 5%. And so if a younger person took a mortgage for say 400,000 and probably put 150,000 to purchase a house in London, then with this increment in the rate, you can easily see that £1,000 a month extra, which is £12,000 a year, and that cannot be afforded by anybody. So this matter needs to be seriously looked at and addressed for the interest of the British people. Now, here we go to the next data. This is the average house price. So you can see in 1985, it's only 34,000. Once again, it just continued to grow. You then start to see probably it there about maybe about 80% increment up to about 98. But I think what I'm interested in is looking at it from say 2009. So on 2009, you can see the UK average house price being 156,000, right? But come 2020, say 2, you can see that figure is nearly doubled 267,388. But this average, really, when you look at the house pricing in London, this averages, the average in London is about 550. And so this is a very sort of modest way of looking at it. So this is what has made it dangerous, because your house prices is basically down a runner and it's left you behind. Your income is not basically tracking this movement, and so you lose your house, and somebody comes from somewhere and buy your house as if this is a game. This is not a game. This is the lives of hard-working families in the UK, and it should be treated as such. Now we come to average earnings once again. If we even use that sort of 2009, let's see, 2009, you have your average UK average income being 25,000, but you can see come 2022, it's only gone up by say 7 or 8,000 at 33,000. Once again, situation is a lot more difficult in London, in the sense that the London average income per year is probably about 42,000, and your average house price is about 550,000. And so these are the dangers that lies ahead, and that needs to be looked at ASAP. Now you go to profits. So this is some information on Shell profits. Once again, you can see it in the line graph. If you come up, you can see it shoots up from 2020, where they double up the prices of fuel. And then you can see that this sharp increase, almost the doubling of the prices of fuel, you can see that is transferred into supernormal profits, because you can see that very distinctive rise in the profits of Shell. And this is, repeated with all the, fuel oil companies, BPs, they all had this supernormal profits. Airport car parking, supermarkets, corner shops. It's basically, it's hard to understand. And even as we know now, even Thames Water, their CEO, Sarah Bentley, she increased the debts of Thames Water from 3.2 billion to 14 billion, 2007 to 2023, and then was dumping sewage in the rivers and British seas. And when she was found out, she simply resigned and then offered that she wasn't going to take a bonus, and we are supposed to be happy with that. Now, this is the sort of thing that needs to be looked at. We need regulation, we need accountability, and we need integrity with the people that we put our trust in to lead our nation. Now, happy to hear from you. Remember to like our video, share, add your contributions. I am interested in hearing what you have to say. Thank you for taking time to watch this video. We will have some more information come up to do with redistribution of income. That will be our next topic. Thank you for watching.